So today we're going to explore the time segmentation quadrant.
It's good for people who want to reduce anxiety. Now, there are cons. So the cons really to this are...
Who fits into this quadrant?
It's good to have this education, have this knowledge, but the best way to figure out what bucket you fit into is... Hello and welcome to another episode of Your Retirement Planning Simplified. I am Joe Curry, along with my co-host, Lindsay Wilson. How are you today, Lindsay?
I'm good, Joe. People might hear about this on a later podcast, but I just want to let everybody know that Joe was awarded 4 under 40 by the Peterborough and Kawarthas Chamber of Commerce, and that's recognizing not only entrepreneurial excellence, but also just being an all-around great person for our community and supporter of the local Peterborough community and business. So congratulations, Joe. It's so exciting. It was a great night.
Yeah, thanks again, Lindsay, for the mention. It's kind of funny. I was thinking... now that we've been seeing so many of our clients, which has been great, but things are starting to slow down a little bit on the client meetings. Still have a few coming over the next couple of weeks, but we're back to batching some of our episodes here. So if you hear us message or making the same message on multiple podcasts, now you know that we're back to trying to get a bit ahead.
It. Yeah. And just because it's worth a couple mentions to my mind. So
perfect. Well, I appreciate it. Okay, so Lindsay, today is our last episode in the RISA framework series that we've been doing.
Yes, so today we're going to explore the time segmentation quadrant, which is number 4. So we are wrapping up the RISA framework series. Can you tell us a little bit about this final quadrant?
Yeah, absolutely. So the time segmentation quadrant is probably anyone who's done research on retirement planning or income planning, they may have heard of it as the bucket strategy. So, and you've probably heard me talk about it on the podcast is investing in buckets in retirement, right? So it's a way of organizing your retirement savings into different time-based segments. So basically the idea is to allocate your money based on when you expect to need it. So thinking about short-term spending, medium-term, and long-term spending. So each bucket's invested differently. So based on the time horizon, so shorter-term buckets being more conservative, while the long-term buckets where there's a longer time horizon to recover from, market downturns, for example, typically that bucket's going to be more growth-oriented.
Mm-hmm. And how does someone set up these buckets?
Sure. So traditionally, what it would look like is your first bucket might cover that spending over the next 2 to 5 years, and it's going to be invested in low risk, so liquid assets like maybe cash or cash equivalents, GICs, short-term bonds. And then there would be a second bucket that might cover years from, say, 5 to 10, so looking into the future a bit, so more of our midterm spending. And that might have more of a moderate risk profile, such as so maybe longer term bonds or corporate bonds, things like that, and balance funds. So that would be kind of a mid bucket. And then the third bucket, which is meant for more of that long-term growth. So it could be invested in stocks or more aggressive investments, since the idea with that bucket is you're not going to need to touch it for many years. So the idea is you spend from the short-term bucket, and then over time, you replenish that bucket by selling investments from the longer term buckets as they grow, right? So you always have, for example, that short-term bucket. And then when things are not going well with your long-term bucket, you're not forced to be selling when the markets are down. So the way, if we think about kind of how we typically implement that or illustrate it with clients, is we generally break it into 2 buckets. So we'd have a defense bucket and an offense bucket. And again, we've probably done other episodes on this. But that defense bucket, we might then break into kind of like sub buckets. So we illustrate it as one, but within that, we might have some like cash equivalents for the kind of the very short term, right? So maybe the next 6 months, the next year, maybe the next 2 years. We might have GICs, for example, for kind of the next couple years, right? So they might be what we would refer to as like ladder GICs. So maybe we have like a 2-year and a 3-year, or maybe a 2, 3, and a 4-year GIC, so that those GICs are coming due when we need to replace that short-term cash bucket. And then beyond that, in this, again, still talking about the defense bucket, we might have some low risk bonds to round out the defense bucket for as many years as we want to shelter for that shorter to, this will kind of go shorter into midterm spending. Now, that's going to look different for every client. Some clients would have no GICs and very little cash if they're a little more if they're a little more on that total return segment we've talked about in the past, but we still like the idea of separating into buckets. Or we could have, a heavier weighting in GICs, or someone who's more conservative and maybe some additional years in that defense bucket. So again, that's going to just depend on the client. And then in that offense bucket, that's really where we have the evidence-based, globally diversified portfolio of stocks or companies. And the idea, again, there is more longer term. We want to be able to maintain the lifestyle, keep up with inflation in the portfolio so that our clients, you're able to continue to live that same lifestyle all through retirement without running out of money, right? So ultimately, the makeup of those allocations, like I said, is going to depend on the client, their goals, their risk tolerance, all that kind of things. But we really just want to separate into that shorter midterm spending and that more long-term growth-oriented type strategy.
And who fits into this quadrant?
Sure. So the quadrant it's a great fit for people who like some structure and they want a plan that aligns their investments with their spending needs. So it's good for people who want to reduce anxiety and those short-term market fluctuations because they know and it does that because they know their needs are covered by those safer assets, right? So it's popular among people, so maybe our listeners who don't want to be too conservative, but they also don't want to be kind of all in on market growth, right? So, and to be honest, in a lot of ways, the strategy is like that total return approach. However, there's a very important and impactful behavioral benefit for many people by just separating the portfolio into these buckets, right? So that separation allows for some mental accounting, you could say, that allows it or makes it easier for people to stick to the plan when they can see those safer assets are allocated to short and medium term type investments, despite whatever's happening in the market at the time.
Mm-hmm. So I think it's worthwhile to go over the pros and cons.
Yeah. So the pros, we've kind of hit on them, but really it's helping retirees balance the need for immediate income with that need for long-term growth. So again, we don't run out of money in retirement. So we can manage the risk while allowing for the growth. And psychologically, like I said, this is a big piece of it, that behavioral piece. It gives peace of mind because you can see that you won't need to sell those long-term investments in a down market because you have that shorter term, safer defense bucket, as I put it. Now, there are cons. So the cons really to this are kind of the complexity of setting it up and managing those buckets. So it requires a little bit more regular monitoring and adjustments. So especially if you're doing this on your own, some people might feel overwhelmed by those different moving parts and trying to balance the buckets. It also is typically a little less efficient. A little less efficient than a total return strategy, especially if we're not rebalancing into both buckets. So what we will often do for clients is we set them up in those buckets, but we'll still commit to rebalancing the buckets back to a predetermined allocation between the two. So that means that if times are bad, we'll take money from the defense bucket and move it back to the offense bucket. So rebalancing, so we might have a mix, kind of, again, just like the total return strategy of say 60% in your offense bucket and 40% in your defense bucket, just as an example. And then that way, if markets are down, we're taking from the defense bucket, rebalancing to the offense bucket to buy while markets are down. So the buy investment's cheaper. And the flip side, just like the traditional bucket strategy, taking money from the offense bucket to replenish the defense bucket, what's coming out of there, as people are taking income from their portfolio to make sure we continue to have that defense bucket in place. So the real idea behind this is not giving up the efficiency of the total return approach, but still separating it so that we can see that we have that safe bucket. So even if markets are down, we can take away some of that anxiety. So it's a fairly straightforward approach, just a few more moving pieces than the total return approach.
Mm-hmm. And so that really brings us to the end of our RISA series. Joe, any final thoughts, any ideas that you'd want to plant in our listeners' mind?
Sure, yeah. So short and sweet this episode, but I think the whole idea of what I want our listeners, what I want you to take away from this is that there is no single strategy that's perfect for everybody, right? There's pros and cons to all the different strategies we've talked about. But now I hope that with this RISA framework we've talked about in the 4 different quadrants, hopefully you have an idea of what is available so that you can start to think about building the retirement plan that's going to fit your risk tolerance, your comfort level, your goals. So whether you're more into guarantees and commitment or more into total return approach and getting growth from the markets, there is that option for you. And I guess I would say I'm jumping right to the action segment here, Lindsay, but it's good to have this education, have this knowledge, but the best way to figure out what bucket you fit into is to do the RISA assessment. So understand what your style is, and you can do that by either emailing us, info@retirementplansimplified.ca, and just requesting a link. We'll send it out to you. Or you can go to retirementplansimplified.ca, click on the blogs, and find any of the RISA episodes. Retirement income style awareness assessment episodes. Had a blank there for a second. But anyway, and if you go in there, in all the show notes, we'll have a link so you can go on and do the assessment and find out what your retirement income style is.